Welcome to your weekly personal finance segment. Here in the U.S., there is less than 1 week until the tax filing deadline on April 15th. Now, there are always changes to the tax code, and both tax preparers as well as taxpayers do need to keep abreast on the latest in the tax code. Now, joining me today to discuss some income surprises is Michael Keating of InnerHarbor Advisors. Mike, thanks for joining me today.
Thank you, Remy. Happy to be here.
Well, there are some surprises in terms of income that can be taxed. We won't be talking about these, but apparently Social Security as well as gambling and even medical marijuana can be taxed. So which ones will we be talking about today?
Right. So income is normally a great thing. Income taxes, not so great. It's when you get a surprise on your income tax return these are the surprises that you want to avoid. So the three that we're going to talk about today are debt relief, alimony, and unemployment benefits.
And Mike, let's start out from the top. Given debt forgiveness, what exactly does that entail?
So the best way to think about it is if you have a debt outstanding and that debt is forgiven, the amount of that debt becomes income, and you owe income taxes on it. Something to keep in mind, the largest source of debt forgiveness, especially since 2007, is a mortgage. If somebody has their mortgage underwater and the debt is forgiven. So in that case, from starting in 2007 and up until today, if you own a primary home, it's not for second homes, vacation homes, it's only for primary homes, and your debt has been forgiven, you don't owe income tax on that. All other debt forgiveness becomes income to you and is therefore taxable.
And I think it's important to clarify that, so thanks for bringing up that example.
Sure.
And in terms of alimony, what is and what isn't taxable?
Alimony, in the strict sense, which is a payment from one spouse to the other, is income. And it's important to keep in mind that alimony, which is, again, a payment from one spouse to the other, is income. Child support is not. Child support is not considered income, and if the divorce decree makes a distinction between the two, it's important to keep the two separate because you're going to owe income taxes on one at the end of the year and not on the other.
And Mike, moving on to unemployment, now there are taxes both on the federal as well as a state level depending on which state you live in. Yep. But could you tell me about this and what are you taxed on?
Well, that one actually makes a little bit of sense because if you're receiving unemployment benefits, that's your income while you're not employed in your primary source of work. So that is income taxable. One thing to keep in mind, if you're going to sign up for unemployment benefits, see if you can have your taxes withheld right up front so you're not hit with a surprise when you file your taxes.
And Mike, last but not least, before we wrap it up, I'm sure that you've been working with a lot of clients heading into the April 15th tax filing deadline. So do you have any recent examples that you'd like to bring up and might be helpful for our viewers in the audience?
The example I can think of is something that we started about a year ago. A client was recently divorced. She had never filed returns on her own. She was receiving substantial alimony. We told her right from the beginning, take about 30% of that and put it into a separate account because you're going to owe taxes on it. That was a surprise to her in the beginning that she was going to even have to owe taxes on it. But the fact that she was prepared for it, when she got her tax bill and it was substantial, she had a reserve of money to pay the taxes. Now, nobody's happy to pay income taxes, but at least she had the money. She was prepared to make that payment.
Okay, Mike, well, thank you so much for that example, and thanks for highlighting some of these income surprises today.
You're welcome. Thank you, Remy.